Happy Monday, everybody. I hope you had a great weekend. As we do at this time every week, let's review last week's market action. Let's preview the week ahead. Today is July 8th, 2024, and this is your Monday market update. Last week was a holiday week, of course, with July 4th having closed the markets early on Wednesday and for the day on Thursday. So, as promised last week, I wanted to give you some of the statistics on the second half of the year. More to come soon. I'll add in some on the election year information and more seasonality. Stay tuned for all that. First, let's just talk about July. According to LPL research, since 1950, the S&P 500 has generated an average return of 1.3% during July, and that was higher than 60%. That was higher 60% of the time. Recently, since 2014, July has traded higher every year. As for the second half, the average second half return of the S&P has been 4.8%, and it was higher 71.6% of that time. Now, when the first half was up over 10% like this year, the index was up an average of 7.7%, and it was positive 83% of the time. That all being said, we know that it's just past data, and if anything else, we know that past performance does not guarantee future results. There have been a lot of stats that have not carried forward in the past few years. You don't hear much about those, but they are happening. For one, June, last month over the past 20 years has been the third worst month of the year, and for the month of June, this time, the Dow was up 1%, S&P up 3.5%, the NASDAQ was up almost 6%. Not bad when the average S&P return in June in the past 20 years was a loss of 0.5%. Not saying things are different this time, just trying to keep things real. Now, let's go back to the week. Monday kicked off the new month and new quarter just much like we left last quarter and last month. Markets were slightly higher at the open, and with some overhang coming off the market, French elections were not as bad as some thought it may be, and the global eco data pretty much was Goldilocks. Buying continued in tech with the AI enthusiasm, as I've spoken about, and the bad news is good news for the markets. Kept going as eco numbers were a bit soft. Markets had some knee-jerk selling on the ISM number, but that did not last. And as details were better than the headline, markets resumed the moves up. Did not get to morning highs, but it did finish strong. The Dow was up less than 0.25%, S&P was up 0.25%, and the NASDAQ was up over 0.75%. Tuesday saw stocks gap lower at the open, believe it. Admittedly, things are quiet this week with the holiday and the travel. Friday will once again bring big news, jobs. When people are not at their trading desk, it may leave the algos in charge, but we'll get to that in just a moment. The ECB's version of Jackson Hole was ongoing in Portugal, and markets were reacting to the ECB President Lagarde, who that did change when Powell actually spoke, and he did have a lot to say. Not much new. His comments were well received, though, and brought the dovish money flows in. That was one of the major market catalysts in the markets for the week. More to come later in the week, we would see. Fed head Goolsbee got in on the action and supported the dovish move. Jolts came in higher than expected, but that is mostly ignored, certainly with Friday's jobs number looming. So by the end of the day, the Dow was up almost 0.5%, the S&P was up 0.75%, the NASDAQ was up just under 1%. As the market prepared for a busy but short day on Wednesday, the ADP labor report came out, and the increase was less than expected, the lowest since January. In case the reports get confusing, this is the private payroll ads report. There were less jobs than expected created. Bad news, of course, is good news. And the jobless claims were higher and the continuing claims were higher. So that keeps telling the story. The market opened pretty flat on that news. The eco data was U.S. eco data was the ISM services, and that fell into contraction territory, worst reading since 2009. And that just lends more to the idea that growth is slowing. As I've said, in my opinion, growth is the biggest risk to this market. We are not priced for slowdown in growth. After the bell, the Fed released their minutes, and there were some notable takeaways. Quick rundown, though I remain in the no cuts before the election camps. December, if at all, in 2024. Minutes note that inflation remains elevated but has shown modest progress in the past few months. Also noted that they still need favorable data and there are still upside risks to inflation. Of the 19 voices in the room, some indicated holding was best, some thinks cutting is soon, and there were even some raised comments. They keep their options open. And again, I contend that they do not want to surprise markets. Maybe November meeting, which is right after the election, they may drop some more hints and then maybe a December cut. Before that, they may be reacting to much slower growth, and that will not be a soft landing. That will be a hard landing, and the market is not factoring that in. That was all after the close, so it had to wait to age over the holiday. At the close on Wednesday early, Dow was down slightly, S&P was up 0.5%, the NASDAQ was up close to 1%. On Friday, markets opened again after after close on Thursday. Again, little change in reaction to the pretty much inline jobs report. The unemployment rate did tick up and less jobs than expected, but not too many. But you also got 100,000 plus revision to the downside for April and May. All of the data was digested, and the case for a September rate cut got stronger, according to markets. Notably, the unemployment rate ticked up to 4.1%, the highest since 2021. Overall, eco data for the week was pretty clear as it can be to most, at least. The economy is not weak. Rates will come down sooner rather than later. I still have to maintain that my opinion is that we won't see a rate cut before the election. But if they set things up at the July meeting, we could see September. I just don't think it's going to happen. I also maintain that the conversation needs to include the fact that the market is going up on this news every time the news comes out. Over and over again, reacting to the same news. Valuation does not usually stop a bull market, but I think it should enter the conversation at some point. As the short week ended for the day, the Dow was up less than 0.25%. S&P was up 0.5% to another new high. The NASDAQ up almost 1%, also another new high. For the week, the Dow was up almost 0.75%, S&P up 2%, and the NASDAQ up 3.5%. Moving into this week, when most people will be back at their desks, this will be a big week. Macro-wise, there is a lot going on. We have possible movement in the Middle East. We have new aggression in the Russia-Ukraine war. NATO is meeting in D.C. Biden and all that's going on with the election, and that does not even really include any of the market events. For the week, the market events, we will get two big inflation readings, CPI on Thursday, PPI on Friday. Before that, we're going to get Powell speaking to Congress. This is semi-annual reports, and since he and the other Fed heads have been all over the tape for months, again, I don't expect much new. We are going to get labor reports like usual on Thursday, and these are being watched. Jobless claims and continuing claims. We'll end the week with the University of Michigan data on sentiment and inflation expectations. Sprinkled in there, of course, will be the Fed heads. In addition to Powell, we'll hear from Barr, Bowman, Goolsbee, Cook, Bostic, and Musalem. And although I think the Fed will take most of the oxygen out of the room, we do have earnings starting again. Yes, as usual, we'll hear from the banks as the week closes out. Keep an eye on what they have to say, and we'll also get Pepsi's earnings, and that is something people may watch for that consumer demand. Okay, the planning, more on the planning side on Friday. Back to the market updates again next Monday. Stay in touch and have a great week.